we mentioned that for the cost of capital is looking at the cost that our investors want to return to them. And it'll depend on how much is debt and how much is equity. So we call this the weighted average cost of capital. Let us see how we calculate the weights with a simple example. So equation 13.2 tells us that the cost of capital for a levered firm is the fraction of the firm value financed by equity times the equity cost of capital plus the fraction financed by debt multiplied by the debt cost of capital. Now, if there are taxes involved, which there probably are, then we'll want to use our after-tax cost of debt, but I'm getting ahead of myself. So because the return of the portfolio is equal to the weighted average of the returns of the securities in it, this equality implies the following relationship in this equation. Now, the equation shows that we can calculate the cost of capital of the firm's assets by computing the weighted average of the firm's equity and debt costs of capital. Intuitively, the firm's overall cost of capital should be a blend of the cost of the different sources. But what should these weights be? Imagine you owned all the stock and all the debt of the firm. Your return on the portfolio would be the total return of the firm. Your portfolio is a weighted average of the return you earn holding all the stock of the firm and the return you earn holding all the debt. So the portfolio weight should adjust the relative amount of debt and equity issued by the firm. For example, if the firm is financed 30% by debt and 70% by equity, then the weights used in the WACC would be 30% on the debt cost and 70% of the equity cost. Let's look at a very simple example. You all heard of McDonald's. Let's assume that McDonald's has debt with a market value of $18 billion outstanding and with common stock market value of $52 billion and a book value of $36 billion. What weight should they use? Well, you must use market values of debt and equity in the financing, because the cost of capital is based on the investor's current assessment of the value of the firm, not on their assessment of accounting-based book values. So we could ignore the book value of equity. Sometimes the market value of debt and the book value of debt are the same when interest rates are what they were when the debt was issued. But we must always use market values, not the accounting-based book values, which reflect historic costs. Market values are forward-looking, based on what the assets are expected to produce in the future. So given it's $18 billion in debt and $52 billion in equity, the total value of the firm is $70 billion, 18 plus 52. So our weight here of debt, 18 over 70, is 25.7% debt. Our weight of equity is 74.3% equity. So that is the calculation of our weights for our simple problem in the weighted average cost of capital.